23 seconds away from the opening bow this morning. Good morning as we grind our way towards that cash open. Equities right now down by 0.75% on the S&P. On the Nasdaq down by 1.2% following 4 weeks of gains on the Nasdaq 100. Up about 11% year to date. Unreal rally. Let's open bow, switch at the board and get to the bond market. Yields pushing a little bit higher right the way through the curve. Twos out to 30s through much of this morning. Your 10-year right now. Yields higher by 4 or 5 basis points on a 10-year to 354.95. Elsewhere in the FX market, euro dollar 108.84. Just about positive on the euro side of things, up more than 0.1%. As we've said a few times this morning, Spanish CPI comes in hot. German GDP comes in soft. The ECB on Thursday still expected to hike 50 basis points. Look out below for crude, down by 1.5%, $78.50 on WTI. About 25 seconds into the session, we're down 0.6% on the S&P. On the Nasdaq, we're down 0.9%. One stock to watch at the open is Bed Bath & Beyond. The retailer emptying shelves as it could be edging closer to bankruptcy. Bloomberg reporting it will likely face Chapter 11 without a bidder for its assets. With more, here's Abby.
And John, if you can believe it, I've actually been in one of these stores recently, and there were a lot of empty shelves, but not maybe as many as you would think. A lot of pared down inventory from days prior when this store was stocked with everything, and a piece of this unraveling. But relative to the stock, today's nearly 3% decline, or actually at this point 1% decline. That's nothing. Down 22% last week, down 83% last year. And of course, the newest developments, that idea that we are moving toward bankruptcy. The last week, the company announced that they had, in fact, defaulted on credit lines. And we also had S&P downgrading their credit. They've closed many, many stores. They announced 150 last year. At this point, it's closer to 250 that they'll be closing. This stock, not surprisingly, none of these developments all that much of a surprise. So there's a big bearish short interest in the stock, 47%, one of the highest in the S&P 500. But take a look at the stock from its peak, down 95%. Again, this points to the idea that you do have bankruptcy looming. It's amazing to think, John, that just a couple of years ago, back in 2021, in the peak of meme mania, it had been a $50 stock. Now it is a $2.52 stock. Meme malaise, perhaps.
Abby, thank you. We'll keep on top of that story. Here's another one for you. Tesla. In the early part of trading, up by about 1%. Last week, up by 33%. We've asked the question, are there price cuts everybody else's problems? Ford, it might be a problem for them. Following in Tesla's footsteps, cutting the price of its electric Mustang by an average of $4,500. Kaylee has more. Hey, Kaylee.
Hey, John. Yeah, Tesla is down the better part of 2% right now on this news. It seems that they took a look at Tesla's price cuts of about 20% across its lineup and said, okay, yeah, if we want to compete, we're going to have to do that too. So that's exactly what they're doing with their electric Mustang, the Mach-E. They're cutting it, as you said, on average by about $4,500. It's a $900 cut for the cheapest model, which will now cost you just shy of $46,000 to start. The price of the GT extended range version will fall by $5,900 to start just under $64,000. So this move also will bring the Mach-E in line with a new cap on EV prices to qualify for the federal tax credits of up to $7,500 under the Inflation Reduction Act. So likely there is more than one motive here. The thing is, though, John, Ford already has described this model as unprofitable. So it raises the question of further margin pressure. Ford's gross margin of 8.5% is much tighter than Tesla's, who had a gross automotive margin of 25.9% in the fourth quarter. So Tesla, in theory, has a lot more breathing room. Ford says it's hoping to offset further deterioration in margins by boosting production by 67%. But if you're going to make more cars, you need the demand to buy them. So again, it all comes down to competition and this brave new world for legacy automakers who are now competing with Tesla, who in many ways was a first mover in this EV space. And of course, you've seen the dramatic outperformance of Tesla stock over the last 3 years as a result. That continued last week, John, as you said, with its best weekly performance going back to 2013 after it reported earnings. We get earnings from GM and Ford this week. So it'll be interesting to see what kind of catalyst and if any more pricing announcements are made, John.
Unreal moves. Kaylee, thank you. Tesla up more than 30% last week, up more than 40% year to date. Will be very interesting to look at the relative price action between Ford and Tesla through today's session. Tesla right now just about negative by 0.25%. Ford down a whole lot more than that. Dan Ives of Wedbush, a bull on the stock, said this out on Twitter just moments ago. Ford cut Mustang EV prices in response to Tesla's price cut. Mini price war about to begin with EVs in the United States. A story for us, that's for sure. Another one, big tech, under pressure going into a key earnings week. This coming as the Nasdaq 100 heads for its best January since 1999. Kelly Greifeld, it's been phenomenal.
It's been phenomenal. And big tech, it is dropping like a stone today. But if you look over the past 19 trading days, the NASDAQ 100 has gained about 10% or so. And if you add that together, that's the best January this century for the index, John. So you can say it's overdone, but you can't ignore it. And if we take a look at what's leading that rally, Lucid is out front, as is Tesla. So a very 2020 feel there. Warner Brothers Discovery also more than 50% higher so far this year. And you have some chip names in there as well for some good measure. So that's the NASDAQ 100, huge rally. But if you broaden out to the S&P 500, we're talking about a 5% or so rally there as well. And typically 5% gains in January, they've led to an average full year gain of about 21% on average in data going back to 1960. So history is on the side of the bulls, but we have two big tests in earnings and in this week's Fed decision, John. So stay tuned.
Katie, thank you. What a week ahead. I've said that about 50 times this morning. The question I'm interested in, though, is what you're interested in. Is it the Fed chair decision, the news conference on Wednesday, or is it the data on Friday? Have you had your pick? Nuveen's Tony Rodriguez earlier this morning saying it was all about the data for him and not about the Federal Reserve decision. I'll ask more guests that through the week as we anticipate both those things. Citi's Kristen Biddley warning investors to stay cautious, writing the following: while it may be tempting, do not become prematurely bullish. The recessionary decline in employment and corporate profits has not yet started. Corporate earnings are likely to fall 10%. That being said, there will be opportunities and better conditions to go long risk assets in the coming year. Kristen Biddley joins us right now. So Kristen, you don't like this rally. Walk me through why.
I don't like this rally. I want to, right? Any type of rally that we have that's good for risk assets, I want to be supportive of. Unfortunately, when you look at the quality of this rally, what really drove it? So going into the end of last year, you had a lot of tax loss harvesting. You also had the most bearish positioning that we've seen since the global financial crisis. And so you had very bearish positioning, a lot of selling, repositioning. And when you look at what's driving this rally, it's all of the laggards and losers from last year. And so this is more of a technical rally. It's not something that has fundamentally changed in our opinion. And we, John, happen to be in the camp of not fighting the Fed. As we have tightening financial conditions that have not flowed through, we need to be cautious.
You're not alone. Mike Wilson of Morgan Stanley saying precisely that to kick off the trading week. Kristen, can you walk me through what is on your dashboard that would need to change for you to change your mind?
Yeah, so I think it's really watching the Fed's mandate. Look, it's relatively straightforward. It's just not easy. So it's price stability and full employment. They are going to hang on to the fact that the employment backdrop still looks strong. We are focused on the data as well. So looking at the jobs report on Friday is really critical, but we don't anticipate that we're going to get anything there for the Fed to change course. On the inflation side, while many people think that inflation has peaked and is coming down, do we really think that that's going to come anywhere close to their 2% target? So to answer very directly, what needs to break? It needs to be employment. And we anticipate that is going to happen over the next couple of months, which would change the Fed's path.
So tell me what you're advocating for right now, because it's clearly not the NASDAQ 100, up 11% year to date.
So what we're advocating right now is defensive positioning. So we continue to be overweight fixed income within our portfolios relative to equities. We actually just took gains in our gold position that we've had on for about the past year, and we've reallocated both to the front end of the curve when it comes to U.S. Treasuries. Again, that's just kind of enhancing your cash yield and keeping some dry powder for when markets turn. And we also see some opportunities within European equities and Japanese equities right now, given the valuation differential, but also as a way of playing the Chinese reopening and some of that pent-up consumer spending and consumer savings that could really flow into those economies as well.
You went there, so let's talk about it. The China reopening story. I've got the MSCI China up about 60% from the lows at the end of October. I've got the Golden Dragon Index up about 85%. That's before today's price action. Kristen, and I hear everybody asking the same question. How do I play the China reopening story? Could you make the argument that it's already played out over the last 3 months?
I think you could make the argument that a lot of it has already been done, but I think you still, when you look at, depending upon what index you're using, the Chinese equity market is still trading off more than 30% off its all-time highs. And there's clearly a delineation between what's been happening in the A shares versus the H shares. So again, it's more of a flows and technical element that we could see, where we could see some upward pressure over the next couple of weeks. But again, this isn't a fundamental strategic long-term play. It's more what we saw within the U.S. economy in 2020 and the U.S. market, where you saw that really quick V-shaped recovery that was really driven by by consumption. And we anticipate, like I said, whether that's playing out within the local Chinese equity markets or whether it's playing out in those tangential markets like European equities, whether that's consumer discretionary, luxury good, hospitality and leisure, or in Japanese equities, that's a way for people who aren't quite comfortable going into Chinese equities as a way of finding a valuation play that could benefit from those trends.
Kristen, you mentioned several industries there. I didn't hear mining. Why is that?
Well, I mean, look, that's one of the key areas that everyone's thinking in terms of what could ultimately be some upward pressure. I think when you look at some of the commodity activity that has already played out, we have certainly seen that in areas like copper, in other areas. So while that's not a key play right now, it's something that we're watching it very closely and keeping an eye on those trends.
Kristen, stick with us. We've got more to talk about, including the potential for bankruptcy still ahead. Equities right now, about 10 minutes into the session, lower by 0.5% on the S&P. On the Nasdaq. Great start to the year. Rough start to the morning. We're down about 1% on the Nasdaq this morning. Coming up, bankruptcy looming for Bed Bath & Beyond.
Some of the more recent indicators do suggest also some of the weekly indicators on bankruptcy filings. BCY and Bloomberg has also been deteriorating. So the conclusion is some of the latest few weeks, exactly as you're pointing out, Romania, have been weakening a little bit.
We'll talk about the potential for that up next.
It is still an open question whether we'll have a recession or not. But some of the more recent indicators do suggest, also some of the weekly indicators on bankruptcy filings. BCY and Bloomberg has also been deteriorating. So the conclusion is some of the latest few weeks, exactly as you're pointing out, Romain, here, have been weakening a little bit.
Bed Bath & Beyond potentially inching closer to bankruptcy. The retailer receiving a default notice with creditors demanding immediate payment. A company filing revealing it, quote, does not have sufficient resources to repay the amounts, leading it to consider all strategic alternatives, including restructuring its debt. This coming as Bloomberg reports Chapter 11 could be its next stop. Katie Greifeld joins us for more. Hey, Katie.
Hey, John. Well, if you thought the equity story was interesting, let's take a look at the debt, because Bed Bath & Beyond 2034 debt is trading at just 6 cents on the dollar. For context, anything below 50 cents is considered distress, and this particular security was trading near 90 cents just a year ago. So how times have changed. But if we break down the capital structure, Bed Bath & Beyond has a market cap below $400 million compared to about $3.6 billion in debt. The bulk of that is in long-term debt, about $2.4 billion, the rest in short-dated debt. And as Chapter 11 potentially looms here, there's about $4.4 billion worth of assets that could be recovered. We know it's struggled to move into inventories, rather. That totals about $1.4 billion. Bed Bath & Beyond leases its buildings, so it doesn't own those, and that totals about $1.3 billion. All of that leaves $1.6 billion in other assets, namely its property, plant, and equivalents. Likely won't be sold at market price, so we'll see how this plays out.
Katie, you said potential for Chapter 11. How's this avoidable?
It's a great question. I'm just following the reporting. We'll see if someone steps in to buy these assets, tries to help them out of this bankruptcy, but we've been following this one for a long time.
Katie, thank you. On the latest with Bed Bath & Beyond, City Kristen Bidley back with us for more. Kristen, it's an odd situation where we face the potential, for bankruptcies to pick up. Yes, from a very, very low base, but with the PMI sub 50, the potential for bankruptcies to pick up. What business does high yield credit have rallying to start the year?
I mean, it's super interesting, right? And again, this is why, John, we're playing a little bit of defense here. I don't really understand that tightening of credit that we've seen in the high yield space. I mean, you could argue that it's come in, right? Not just year to date, but for the past couple of months, we've seen that, which is why we believe we're going to see opportunities over the next couple of months, but we are certainly not going long those assets right now. When you look at the cost of capital and how that has doubled over the past 12 months, and you see this continued tightening, that of course is going to flow through not only into earnings, but into balance sheet management. And we should anticipate that we're going to see an increase there.
There is a constructive view out there. It comes from Neil Dutter of Renaissance Macro. And Neil wrote this, Kristen, this morning, just published moments ago. I'll share it with you. The Fed is staring down the barrel of an upturn in economic activity, having seen limited progress in some important metrics such as unemployment and core services ex-housing inflation, and has still decided to step down to 25, signaling that it's close to the end. I can see why markets would like this idea, but it risks the Fed having to step in later. The Fed story only works if the economy is slowing down. Sorry, but I don't see it. Kristen, could you respond to that? Your thoughts?
I actually think we're starting to see a lot of the economy slowing down. So I think a lot of the signal, it's just once we need to kind of get to this point when bad news is actually bad news. So like you said, purchasing managers showed contraction in both goods and services. Granted, it's one data point, but that's something we're going to keep a close eye on. We've seen a big drop in retail sales. We've seen a significant drop in new home sales. The housing market has been significantly impacted, not from a price standpoint, but obviously from a sales standpoint. And then you're seeing retailers impacted in terms of inventory bloat, less productive headcount. So all of these different signs are actually showing that the Fed's medicine is indeed working, but for it to turn up in the data in terms of their two key points, both in the employment market as well as inflation, is taking some time.
Do you see sufficient evidence for them to back off then, to back down to 25 and maybe to deliver what could be their penultimate hike?
I mean, this week, I think 25 is our base case, and I think we'll continue to see that. I don't think there's any advantage to Chair Powell right now in terms of what they hope to achieve and the targets that they have, delivering anything other than a hawkish message or potentially something that is just we're higher for longer, which is obviously still tight financial conditions. So I don't think we're going to get anything out of it this particular FOMC meeting. However, I think in March, there's a lot of data that is coming out over the next month that could actually indicate some trends within in some of these areas that I mentioned. And so we're really looking out to March if there's any type of change in the rhetoric whatsoever.
So, Kristen, with that in mind, what is more important this week? Chair Powell on Wednesday or the data you get through the week, which concludes on Friday with payrolls?
The data. I think the data. I think we anticipate, like I said, that he's going to have a hawkish message. We largely think that 25 basis point hike is done and dusted. And so the data in terms of actually showing some of these cracks, some of this sustained decline is what we're really looking to. I would say the most interesting area, though, John, so part of it is wages, and we're going to keep a very, very close eye on that. But I also think we need to keep a close eye on the services data as well. Goods, we've already seen that declining. We're seeing that inventory bloat. Services has been a little bit more resilient. And so I think that's an area that we and the Fed are going to keep a close eye on.
Kristen, just finally, given that you're more focused on the data than you are on the words of Chairman Powell, does that say something about the weight of the words that Chairman Powell has these days relative to maybe a few months ago? It seems to me that I can sit here and say the most important question on Wednesday is how he responds to the question, what do you think about the easing of financial conditions? Is it warranted or unwarranted? What really matters ultimately is how this market chooses to respond to how he answers that question, Kristen. And ultimately, over the last couple of months, it seems to me at least, and others too, that when these Fed officials speak and say no cuts, no cuts, no cuts, fewer and fewer people are listening to what they've got to say.
Well, I think from my perspective, it's just that we largely are anticipating what he's going to say. So I think the message, almost the expectation is that there will be hawkish commentary. And so anything that would come in underneath that or not within those expectations could actually be a positive sign. But I think if the base case is that you expect him to be hawkish, reinforce that message, kind of going back to the minutes from the December meeting where he didn't like the fact that financial conditions were loosening and the market reaction to that. I think a lot of this is the market anticipating that and expecting that. And we're really focused, like I said, again, we're cautious, we're defensive because we're focused on the data and we're focused on that employment number really starting to break. And once we see unemployment uptick, that is something that gains momentum and it happens quickly. It's almost like everything, like all at once when you start to see that data start to flow through. And that's going to give Chair Powell and the Fed a tough decision in terms of balancing that mandate. And we believe that they're going to err on the side of making sure that the employment picture is intact.
Plenty of data still to come. Kristen Bidlier-City. Kristen, wonderful as always. Thank you. Looking ahead to the economic data, not just Chairman Powell. If you'd like a sneak peek into payrolls Friday, I can give you our survey right now. The median estimate, moving target, we'll get more estimates through the week, but as things stand, the median estimate right now, 185k on the headline number for payrolls. The previous view, 223. On unemployment, 3.5% last time around. Looking for that to climb to 3.6%. And those of you interested in wages month on month, 0.3, looking for 0.3 again. Average hourly earnings year over year was 4.6 previously, looking for 4.3% this time around. As I say, that's a sneak peek. It's incomplete. We'll get more estimates through the week, and when that starts to move again, I'll bring you an update. Let's get you some sector price action just briefly. Here's Abby.
Hey, John. Well, we have somewhat muted sector action at this point. The S&P 500 off of its lows, down 0.4%. That Dow, which I know you don't like, but it is fluctuating higher, suggesting that maybe we're going to see something similar here. So at this point, more sectors than not are higher. Not huge gains, staples, materials, healthcare, utilities. On bottom, energy down in line with oil. It's interesting. We've been talking about Bed Bath & Beyond all morning. One sign of risk on sentiment. It has flipped higher, up 8%. We also have Carvana trading up 18%, but trading to the downside, China Tech down 4.2% overall. Some of the larger laggards there include Bilibili and Pinduoduo. But of course, that sector since October, as you know, John, off the lows, up more than 70%. Really pretty incredible.
Soft start to the week, that's for sure, Abby. Thank you. Down about a third, though. No real drama here on the S&P relative to the big gains year to date. On the Nasdaq, we're down about 0.75% on the Nasdaq right now. Up next, your trading diary from New York. This is Bloomberg. 25 minutes into the session, taking the smallest of bites out of the year-to-date rally so far. On the S&P, we're down about 0.5% on the day. On the year, up by about 5.5%. On the Nasdaq, down about 1% on the day. The Nasdaq 100 on the year is still up around about 10 full percentage points. That's the price action. Here's your trading diary. What a week ahead. Tech earnings continue. Snap, Spotify on Tuesday. Fed decision Wednesday, followed by earnings from Meta. Rate decisions from the ECB and the BOE on Thursday, plus results from Apple, Google, Amazon still to come. And then it's payrolls on Friday. From New York City, that does it for me. Packed few days ahead. Looking forward to covering it with you. Thank you for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Monday, January 30th. Here are the top market stories that we're following for you at this hour. Guys, inflation can come back. Spain shows what markets fear, that prices can rebound after easing. Equities lower, yields rise, which leads me to terminal impact. Fed, ECB, BOE will hike rates this week. How close do they bring them to their peaks? We're going to break it down. And JP Morgan sells sell any rally. The bank warns of an air pocket of weaker earnings and activity. We're going to get the preview on tech with Kamran Ansari, venture partner over at Greycroft. From New York, I'm Alex Steele with my co-host in London, Tom McKenzie. Guy Johnson is on assignment in Seattle. Welcome to Bloomberg Markets. Tom, I appreciate the Dow's making a run for it. The S&P definitely off its lows. But I feel like how can you take on a big position or conviction when we're headed into this week?
Yeah, is this a healthy pause, as you say, ahead of those central bank decisions, of course, and the rhetoric that we're going to be hearing from the ECB, the BOE, and of course, Jay Powell, as officials, particularly around the Fed, start to think about a 25 basis points, are we going to get a hawkish step lower from the Fed chair?
Yeah, and that maybe baked into the cake, but what wasn't baked into the cake was over where you guys are. I mean, inflation rises and then growth rolls over in Germany. That was not a good feeling when it came to the market. So lots coming up this week. And tomorrow, tune in, Guy has an exclusive interview with the CEO of Boeing. It's why he's in Seattle. And then he'll make a pit stop, Tom, here in New York.
Yeah, the lucky people of New York with Guy Johnson in town. That is going to be a fascinating interview. So much to talk about, of course, with the head of Boeing, particularly around the Chinese reopening as well, how much demand they expect to see from that market. It is, of course, as we said, a major week for central banks then, with the Fed, the ECB and, of course, the BOE all out with rate decisions. Our question of the day then focused on the terminal rates impact on markets. Joining us to discuss are Bloomberg's Kriti Gupta and Ira Jersey of Bloomberg Intelligence.
All right, guys, let's kick it off. Ira, how about you? Terminal impact. When we get to, first of all, we get closer to terminal this week, what does that look like and how do markets react?
I mean, it's not won't be a big surprise if the Fed goes 25. I do agree with the idea that really what Powell says afterward will be, I think, of key importance to how the markets react, because he could be a little bit hawkish, and in particular, he keeps on needing to say that once they reach the terminal rate, they're going to stay there for longer, and longer potentially than what the market's currently pricing. And I think that that's where the market is getting things wrong and kind of discounting the Fed's resolve in terms of how long they're going to keep interest rates at the peak. So regardless of whether or not the Fed goes another 50 basis points or 75 basis points, we're nearing the end. But it's those early cuts that are priced into the market that I think kind of concerns Jay Powell and other members of the Federal Reserve.
And so, Kriti, on that point, do we expect to see pushback? If we do, what is the market reaction then to hawkish rhetoric that accompanies 25 basis points?
Well, you know, I think I actually have to say that I think the ECB, the day later, is actually going to lead the trade. And the reasoning for that is simply because if you look at what the Federal Reserve is doing, of course the hawkish rhetoric is going to accompany that. We know that's what's going to come from because that has been the trend so far. Any sort of dovish pivot is only going to lead to some sort of rally in equity markets, and that is something that we know the Federal Reserve and Chairman Powell don't actually want to see when it comes to loosening of financial conditions. But for that reason, I think all the action is actually going to happen the day after for the ECB when it comes to Thursday, simply because of the reaction you're going to see in the in the euro as a consequence of the dollar, and then the ripple effects in the commodity market and the stock market.
So I think that's a really interesting point, particularly because maybe the equity market then isn't where we're going to see the reaction, Kriti, because today it's really about the bond sell-off that was initiated over in Europe when we did get the higher inflation readings in Spain. Is that where you anticipate the action then?
Yes, because I think that's where the story is going to next. The idea here that, look, we know the United States is slowing down. We know that at some point we may see a recession that perhaps may not be as bad as previously expected in 2022. The wild card is still Europe here, because as the Fed and other central banks around the world, think the Bank of Canada, think a lot of these emerging market banks as well. We were talking about Sherry Allen reporting from Chile just last week. A lot of these central banks are slowing down. The ECB is not, and that is a really big story when it comes to who is actually leading the tightening around the world. And right now, it's the ECB, and the ripple effects, to your point, Alex, are going to be in the bond market, which we're already seeing a sneak preview of today.
So, Ira, on that point, in terms of divergent central banks, particularly pronounced with the ECB, as Kriti so brilliantly outlined there, how is that impacting fund flows? What are the potential bifurcations that we could see in these markets as a result of that dynamic?
Yeah, so not a huge change, I think, in flows. I think what happens is that instead of a shift being, say, out of treasuries and into, say, European government bonds, because they might have higher yields in the not too distant future, there might be somewhat of a slowdown. So I agree with the idea that maybe there'll be a shift away from dollar assets more generally and back into the Eurozone, typically when it's the delta and the change of interest rate differentials that often affects the currency market. So certainly Audrey Child-Freeman, who's our FX strategist, she thinks that the dollar is likely to be weaker over the course of this year than it has been, and in part because of the fact that the Fed's going to be pausing and other central banks, and ECB in particular, will continue to be hawkish in its monetary policy. I think importantly, we just have to remember that even though we might start to see a significant sell-off or continued sell-off sell-off, I should say, in European bond markets. That won't necessarily translate one-to-one into the U.S. because the U.S. has already sold off so much. So I think really interest rate differentials can collapse quite a lot with, say, 10-year German bonds, German Bunds, moving closer toward 10-year U.S. Treasury yields as the year progresses.
Wow, that would be a huge move. They're trading at 226 right now in terms of 10-year bund yield. Hey, Ira, to that point, can you just walk me through positioning? Because it seems like you could make the argument the last few weeks, no matter what market you're looking at, you looked at light positioning, low expectations, and I'm wondering how this is setting us up for Wednesday.
So yeah, positioning has been a major reason why you've seen some of these large moves, and people are a little bit skittish of taking big positions because of the uncertainty about when the future, what's going to happen in the near future. I think it's hard to gauge absolute positioning, right? Because every bond is owned by someone, so it's really a matter of are those bonds in strong hands or weak hands? And I think at this point, people who are long and got long above 4% in 10-year yields, they're happy enough to take some profits here, and you certainly saw that in December. But I think now positioning is much more neutral. So I do think that at least in the U.S., we're in a position where we'll wind up having somewhat of a range-bound market until the market's able to get some conviction about what's happening next in inflation, what's happening next with the dollar, and certainly what's going to be the path of Fed policy later this year.
Chrissy, when we turn our attention to the BOE and that decision, and arguably the stagflationary dynamics that we're starting to see here in the UK, many have argued that in fact the BOE's decision is even more complex. GDP coming in slightly higher than many expected, and of course inflation remaining very sticky, and we have industrial action set to take place in the UK on Wednesday as well. As you start to look and consider the BOE's next steps, how complex is that for the central bank governor?
Very complex. And remember, I think the tandem move that you're going to see from the BOE and the ECB on Thursday, remember they're both coming out, is really important because I think for that specific currency pair naturally, the pound versus the euro, that is going to be the big mover. But to your point, remember the BOE was one of the very first people to come out extremely hawkish. I think they had tightened by, I want to say 50 basis points the first time around, way before anyone else did, something that the Bank of Canada then followed. So I think the real question here is what kind of precedent do these European banks set when they do start to see, to what the point that Alex was bringing up, this idea of kind of Spanish inflation coming back to haunt you. Because Tom, Alex, one of the things that no one's talking about right now is the fact that we are looking at oil prices, Brent crude trading with an 86 handle, and nobody's talking about how close we are to $100 oil. The decline in CPI, all of that was commodity prices. If you see a rebound coming off the Chinese reopening, the Fed is going to have to deal with the same issues the ECB is.
Yeah, and just wait till we get that product ban from Russian exports at the end of this week. That's going to be something too. All right, guys, thanks a lot. Great. I loved ending on oil. I mean, I feel you. Kriti, thanks a lot. Ira, good to see you as well. Coming up, we're going to have more on the question of the day, central bank rate decisions, the market impact with Callie Cox, U.S. investment analyst over at eToro. This is Bloomberg.
The Fed is expected to dial back to a 25 basis point hike.
They want to make sure they don't go too far.
Pivotal moment to make some decisions.
But will they go so far as to signal a pause?
We have a long ways to go.
Trust Bloomberg for the fastest coverage and exclusive analysis, including former Fed Vice Chair Richard Clarida.
Recession fears are tangible.
What's the mistake this year? Doing too little or doing too much?
Stay tuned. This is going to be with us for a while.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
There are opportunities for this rally to go longer and higher than you would expect. I mean, you've got inflation that's likely to come down given the year-over-year comps. Earnings season expectations were so poor. The market was looking for this kind of first half recession, but the labor market's going to take a much longer time to kind of decelerate. So, we think that this strength can go higher. You traditionally have 15-20% rallies when you have Fed pauses. Those are usually suckers rallies, usually. And so I think it's premature to cancel the recession. I think there's so many signs that the economy is likely to head into recession, but it's going to take a while. We think this rally could last us through mid-year, but ultimately we still do have those concerns about recession. We just think that's a kind of second half story, and in the meantime, you've got to play this.
I really like that line. Can't cancel the recession yet. That was Federated Hermes head of multi-asset solutions, Steve Chiavarone, earlier on Bloomberg Television. Let's take it to the question of the day. Terminal impact and the impact we're going to see on the markets, whether you're looking at equities or whether you're looking at the bond market. Well, Callie Cox, U.S. investment analyst at eToro, joins us. So that kind of covers BOE, ECB, and the Fed. This next hike, it takes us close to the terminal rates across the board. Where's the shakeout? What are you thinking about?
So when I'm watching the Fed and the ECB and all the central banks around the world, I'm thinking about the different situations that all of them are in. So of course the Fed is potentially staring down a recession, watching slowing inflation, but inflation that might be hard to get down to their target level of 2%. So whenever I think about banks, of course the Bank of Canada hinted at a pause last week. The ECB could, slow its rate hikes this week as well, give us some different signals. But you have to kind of take that with a grain of salt. Like there's a chance that central banks can correlate across the world, but at the same time, Europe's dealing with supply side inflation. Bank of Canada is dealing with a much different situation. So, I really try to focus on the Fed here and what we're seeing in the U.S. and what the Fed has done historically around moments like these.
Kelly, do you take the JP Morgan advice on to sell into this rally, given that uncertainty, given expectations of higher rates for longer?
Well, we think the air is getting thin up here for sure. I mean, we're optimistic. We're hoping the economy can avoid a recession, but we want to be realistic here. So we're telling customers to really look at value at this point. We all know sectors are moving at different paces right now and are kind of going through their own sector level stories. So, we tell people to take a step back and really look at those cheap cyclicals if you believe that the economy could avoid a recession. If you don't, look at a barbell here, look at defensives, and, look to add some growth if the Fed ends up cutting rates in the future, not anytime soon.
So, Callie, we have the Dow's now up by 0.2. You have the S&P is still down by 0.3. The Nasdaq 100 is down by 1%. But what I find so interesting is if we just take the last couple weeks, and you're taking a look right now at the Russell 2000 versus its 20-day moving average, the ratio, and the NYSE FANG Plus, so that basically all the big tech names, Facebook, Apple, Netflix, Google, etc., and divided by its 200-day moving average. Basically, anything above 1 means that they're rallying above their 200-day. That's pretty broad-based. I mean, that's tech and growth and then value and small caps. How does that make any sense to you?
Yeah, so I think that shows just how quickly we went from overly pessimistic to essentially neutral in sentiment. And I think that this is significant, right? Normally people have their own opinions on technicals, but when there's so much uncertainty in the air, people tend to grasp at lines on charts. And we've seen that in the 200-day when we've looked at past bear markets. It does make me a little bit cautious. It does make me think that investors are rushing off the sidelines and just piling into risk kind of unabashedly. But at the same time, I wouldn't call that an entirely bearish signal here because I think some of that rally is legit in certain sectors.
And because that rally is legit, you still want exposure to risk, but you want it in quality, Callie, and you flagged that for us. Where does that take you then ultimately?
Correct. So right now we're looking at cheap cyclicals. I mean, big tech, quality tech, industrials. I think it's too early to maybe pile out of risk, especially because when we're thinking about retail investors, we're thinking about those longer term investors who could see this as an opportunity here and could wait out any further volatility. But right now we're thinking cheap cyclicals if you're looking in the next 6 months to a year, if you believe the U.S. can avoid a recession, and we're still hopeful that the U.S. can. And when I say quality too, I'm talking quality balance sheets, quality cash flows.
Based on that though, does that mean then we don't get the Fed cuts? Because why would the Fed cut if we're not in a recession?
Well, that's exactly it. So our base case here is we think the economy could take one of two paths, which is a pretty obvious answer, right? They could either avoid a recession or we could fall into a recession. If we avoid a recession, that's the best case scenario, but it does give the Fed impetus to keep rates higher. And that does require you to keep focusing on quality until inflation is down significantly. We hope the economy will take that path. We think investors are being overly pessimistic. But if we see some recessionary evidence, it could be time to, potentially pile it a little bit more into quality risk and, expect the Fed to possibly respond to that. But we don't think we're there yet.
I know you've been kind of getting the gauge, getting a sense of your retail investors, Kayleigh, and I just think about the commodities complex and the China overlay to that. Is there further to run? How much of a catalyst is China within commodities that had such a solid 2022 for this year?
Yeah, it's a great question, and I think it's a very open question right now. I think people on Wall Street and me, personally, are trying to grasp at what China's reopening could mean. I mean, obviously, it's higher demand, and that could hit the commodities complex pretty hard. And what we're seeing from retail investors is, an urge to go global, an urge to get exposure to currencies and commodities. But at the same time, that higher demand could turn into higher inflation, and that, of course, has second-order effects.
Kayleigh Cox of eToro, some great insights. Thank you very much for joining us this Monday morning stateside, of course. Still ahead, price wars are escalating in the EV market. Ford, following Tesla's move, slashing the price of its electric Mustang Mach-E. More details next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. The CEO of TikTok will testify before a House committee on the company's privacy policies and its relationship with China's Communist Party. The hearing is set for March 23rd. It will be Shao Zichu's first appearance on Capitol Hill. FBI Director Christopher Wray has said China's government could use TikTok to control millions of users' data or software. Bloomberg's also learned that the Chinese search giant Baidu will roll out an artificial intelligence chatbot service similar to OpenAI's ChatGPT. The tool will allow users to get conversation-style search results. It's set to debut in March. And Ford is responding to Tesla's recent price cuts. The automaker is slashing the price of its electric Mustang Mach-E by an average of $4,500. The discount comes on a model that Ford has already described as unprofitable. Analysts predict the pace of growth for electric vehicles will slow this year. And that is your latest Business Flash. Alex?
All right, very good. Thanks very much. It is 21 past 7 on the West Coast. Want to get to the startup. We're going to cover all the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. And joining us, Bloomberg Technology co-anchor Ed Ludlow. Ed, I'm looking at Ford, stock down 1.6%. Your take on the price cuts?
Yeah, it's interesting. I mean, our colleague Dana Hall wrote the other day, right, is this the start of the first EV price war with Tesla going first? I think there's mixed opinion on this, right? We write that this is Ford responding directly to Tesla, you know, from a demand perspective. But if you look at where they cut price, Rizka was talking about an average $4,500 cut. That actually on the base model, it's a $900 cut. On the most expensive GT model, it's a $5,900 cut. Why is that important? Because it brings those more expensive models in line with eligibility for the IRA 7,500 tax incentive, right? So it's both sides, response to Tesla, but I also think Ford says we need to make these vehicles eligible for that broader federal discount.
Yeah, good news for EV buyers out there, particularly stateside. What does it mean for margins, though, Ed? They're presumably comfortable with thinner margins to get that market share.
Yeah, I remember being in Los Angeles 2019 with Jim Hackett, the former CEO, when the Mach-E was unveiled, and he said on camera, you can go back and look at it, this will be profitable from car or unit number one. Of course it wasn't, and part of that has been low volumes, right? 2023 is really the year that the Mach-E is going to ramp up its production to the tune of many more tens of thousands of units. That should aid that profitability profile, but again, this is a company transitioning from combustion engine to EV, not a pure play name, and they're still working out the economics.
I love that you brought up the Inflation Reduction Act because it's like maybe it actually is an Inflation Reduction Act because like they have to lower their prices to qualify. If they have to do it, and that's more of the reason, are there other auto companies, EV companies that have to do it at the same time?
Well, that's what I mean about referencing Dana Hall's price war column, because, you know, the next domino to fall, so to speak, I assume is General Motors. What are they going to do in response to their crosstown neighbor Ford and Tesla? But maybe they don't. I think, you know, the issue is still one of demand, right? And Ford and General Motors are supply constrained. In other words, they're building so few units that the demand for their specific products outweighs their ability to supply right now. For Tesla, that wasn't necessarily the case, but that's what we're waiting on, Alex.
Ed, big week, of course, for tech earnings. What are you and the team looking at?
Yeah, I think we look very closely at the chip makers, not just here in North America, but Samsung reports Tuesday, right? And, you know, basically the industry's got it wrong on memory chips. A year ago, we were saying that the boom-bust cycles are over, that actually we'll have better management of our inventories, better management of how we're managing supply, and that's not been the case. There are factories and warehouses with backlogs of inventory, and so customers have stopped ordering. We've already had a profit warning from Samsung. Then the US chip makers report after that, so that will be interesting. And then there's the calendar, right? Mega Cap Tech Week. It all kicks off Tuesday, really, but that single day in the week where you get Alphabet, Amazon, and Apple, it's going to be a pretty unfortunate and unhappy week for me, I imagine.
No, what are you talking about? You're totally going to love it. Going into this, what has sentiment been like?
Well, mixed, because before all the job cuts announcements across the tech companies, we were worried about the earnings risk, right? Earnings on an EPS basis should drop around 8% on tech broadly. Some of it cases it's deeper, like Meta EPS drop is in the 30 to 40% range based on consensus. So the question is, like, how glum is the outlook? Microsoft gave a pretty weak outlook, which made us a bit worried, even though that they had outperformed in the quarter just gone. There is sort of some worry out there about corporate demand, for example. But there's this other school of thought, right, that the job cuts now are very good, because if you're a long-term investor, you say cutting now is painful, but it actually boosts the opportunity to grow earnings on the other side once we're through a recession. And I think that's what the narrative will be this week.
Excellent stuff, Ed Ludlow. As ever, thank you with that preview around technology and, of course, the price-cutting war within EVs. Coming up, we will have more on those tech earnings and what investors will be watching. Kamran Ansari, Greycroft Venture Partner, former head of corporate development, will be giving his views on what to position for. This is Bloomberg.
We're about an hour into the trading session. Tech still getting hit pretty hard here. We're down almost 1.5% in the NASDAQ 100. Abigail's tracking the moves for us. Abigail?
Yeah, we have investors nervous here, Alex, in this Fed week with the S&P 500 down about 0.5%. The NASDAQ 100, to your point, Alex, down 1.3%. Tech really losing more, having to do a lot with the chips and those memory prices that you were talking about with Ed just a few minutes ago. This NVIDIA, one of the top chip stocks, down 3.6%. You also have Micron lower, the stocks overall down more than 1%. And yields are higher, so maybe today that's pressing stocks to the downside a little bit, even though last week's stocks absorbed higher yields. As for the S&P 500, it's still above its 200-day moving average, and it's still above 4,000. This is the bear market of last year. The big question or not is whether or not this is a bear market rally or this is the start of something new. You can see a pretty convincing break above resistance, but you can also see the RSI getting closer to overbought. So let's see what happens here. There's probably more indication to think that it is going to hold above these levels and that maybe we go into some sort of a sideways range, a truce between the bulls and the bears. But time, of course, will tell, and we're getting so much information this week between earnings and the Fed and other economic data. As for the car space, and the EV car space in particular, a price war. Ford, of course, has announced that it's cutting prices on its EV Mustang, that E-Mach, by about $4,500 per vehicle in competition to Tesla's recent as much as 20% price cut. So heating up here, not great for the stocks, at least today. And then finally, let's check in, Tom, on the NASDAQ 100, because we are looking at the best January since 2001, up at this point with today up about 10% or so. You can see the S&P 500 higher too. What makes it interesting, 2001, that was a part of a rolling bear market period between 2000 and 2003. So who knows, maybe this is some evidence of a bear market rally. More information is needed for sure.
Double-digit gains year to date. Abigail Doolittle, thank you very much indeed with what is happening across those US markets. A big week, of course, for bellwether tech as Meta, Apple, Alphabet and Amazon all report earnings. Here with what to expect then is Cameron Ansari, Greycroft venture partner and former head of corporate development and strategy at Pinterest. Cameron, thank you for joining us. Are you gearing up for an earnings recession within tech?
Well, I think this week will be very interesting. You're going to see results, I think, that will largely be better than some of the estimates. I think you've already seen Microsoft and Netflix come out the last couple of weeks with results that beat estimates, and a lot of the doom and gloom that's kind of gone into the analyst reports and so forth, I think are going to be attenuated a little bit by what's happening in the actual results, particularly as you see some of the ad spend probably recover a little bit. I think the major softness will be in the B2B kind of software sales side of things like AWS or Google's cloud business. I'll be curious to see how those results come in.
As you've had the public markets getting hit last year, but this year doing really well in tech, what have the private market valuations done at the same time?
You've definitely seen them come in. At the same time, at a seed or Series A stage, very early stage private companies, we have not seen, I have not certainly seen valuations come in that much, right? There were deals that I thought, we're going to get done at price X and get done at twice that, right? And I get beat on a deal. So, on a seed or Series A deal, these companies are either going to work or not work, whether you paid 10 million, 20 million, 30 million going in for something that's going to be, a massive business, doesn't make that much of a difference. So I think the biggest adjustment on the private market side has been the pre-IPO later stage rounds, which have come in a lot. And you've also seen a lot of the deals that were priced in the pre-IPO, Series D, E, F. Stripe, for example, which just recently cut its valuation, I think, internally from 95 down to 60. Instacart went from, I think, 40 billion down to 10. So those private valuations on the late stage deals that were done in the last couple of years, those have been adjusted in quite a bit.
And Cameron, with those funding channels starting to be tightened, particularly within the startup space, are you looking at consolidation? Is this the year of consolidation within startups as they see that runway just diminish?
Absolutely, and I think you're seeing startups kind of cut costs and trying to raise smaller bridge rounds and things like that to give them more lifeline. But as the year carries on, I think you'll absolutely see consolidation in the tech space. You'll see startups combining with other startups. You'll see the larger private companies, folks like a Stripe or Instacart, scooping up and buying smaller businesses that are not going to get to the next funding round. And I think the bigger thing you're going to see as well is that the large tech firms that do private equity, for example, Thoma Bravo, Vista, Silver Lake, these guys are going to be very active buying up some of the better tech assets, both private companies as well as the public names that are trading at incredible valuations. You saw Sumo Logic is now potentially in play, Anaplan, Coupa, Avalara, those guys all got bought already.
Do you feel like the moves we're going to see are going to be defensive or valuation driven or offensive? How are you thinking about it?
I think it'll be a combination of all those. I mean, a lot of them will be valuation driven because you have great assets that maybe were overpriced in the last few years, and you have folks on the sideline with massive cash stockpiles. You have both, again, private equity and venture firms, as well as a lot of the big public tech companies, folks like Salesforce, Oracle, Amazon, Google, et cetera. These folks have, huge cash stockpiles, and they've been relatively quiet on M&A. And so I think, as you're going into the new year, both the private equity firms and venture capital firms and the public tech companies have these, big amounts of cash on hand and attractive valuations for companies that maybe they've had their eye on for years, and this is the year to go shopping.
I just want to pick up on something you said about ad spend, because it's really interesting as we head into that potential recession. That ad spend, do you think is going to be relatively resilient? So important for companies like Meta. Do you think that holds up this year?
Yeah, I mean, I think you saw in Q2 and so forth, Snap and others warned that ad spend was down significantly or is going to be soft this year. And I think, it'll certainly be soft, but I think, again, the doom and gloom projections that you probably saw put out earlier in the year may not hold up as you start to see Q4 numbers come in. Keep in mind, Q4 is always the largest largest quarter for online ad spend and for consumer retail spending, which is really going to benefit folks like Pinterest, like Google, like Amazon when they put out those results. So I do think you're going to see some resilience there, and I think you're going to see that market starting to come back this year as well.
What do you make of all the layoffs that we see in the tech space?
I think it's a result of growing too fast in the prior 2 years, right? I think it's
So it's normal but not normal?
I would say that. I would say it's an adjustment, a reaction to kind of overgrowth. And famously, the one company that's not yet announced layoffs is Apple, right? All the other peers have announced layoffs. And one of the reasons people have cited that Apple has not announced layoffs is that they actually hired much, much more slowly the last couple of years. So they didn't do this, we got to hire everybody. It's a, arms race for talent. They've always famously been very judicious and kind of prudent with costs. So, it may be to their benefit now where they don't have to do a major layoff because they've also hired much more slowly.
When do we start to see the margin impacts of those job cuts?
Great question. You're not going to see it this quarter. A lot of these companies, when they go through, they announce a 10,000 person layoff. There are severance packages and things like that are going to go on for months and months. So I expect sort of towards Q2, Q3, you'll see the margin improvements and bottom line improvements on earnings that result from the layoffs and the cost cutting. But you're not going to see it just yet. So I think it'll trickle in the coming months.
Do you feel like cutting like this for margin improvement in the back half, can you still be a growth stock, a growth company, like cut to grow? Is that a thing?
I think you still can, particularly because, if you're cutting in areas where you have, duplicative roles or you have entire segments that aren't performing. For example, Amazon, I think shuttered a lot of its retail offline stores that were not performing well. So if you're getting rid of an entire segment of business, and that's going to help you cut costs, then I think you can focus on things that are growing, like AWS, which is still growing, probably 20%. It grew 30% last year, maybe it grows 20% this year, but that's still significant off a $20 billion business. So you can focus more on the things that are doing well and kind of get rid of some of the businesses that maybe weren't performing at all.
Cameron, one last one, because you touched on Apple, you touched on the fact they haven't cut jobs yet. The pipeline, are you concerned about the pipeline for Apple? Do they need new products to be hitting the shelves this year to kind of get past the supply chain constraints of China?
Yeah, I think that's absolutely the biggest concern with Apple. I think there was a report that the iPhone sales may have been down about, or shipments may have been down about 15% in December. That's not confirmed, but that was from IDC, I believe. And there are the supply chain slowdown and shutdowns in China, particularly from the COVID things that have happened in the last 6 months, that will affect Apple significantly. So I'll be curious to see how that impacts the numbers that come out this week for Apple.
So actually, let's end on China for a second. So how do your clients and you see opportunities or not with China reopening and then all the onshoring? Like, is it going to help? Is it going to hurt? How does it change valuations?
So I think for companies like Apple that are supply chain dependent, having China reopen obviously is going to be a major boost. And any company that provides hardware, even Google and Amazon obviously have devices that they put out, so that'll be a benefit to them to have China reopen. For the majority of software companies and folks in the internet e-commerce space, they don't do a lot of business with China, so it doesn't impact certainly a lot of the private companies that I work with that much. It's sort of a non-factor other than how it impacts the broader economy.
Really great. Wonderful to get your perspective. Super appreciate it. Kamran Asari of Greycott. Thank you so much. Come back. Love to get an update as we go through this process. On a macro front, we do have some breaking news here. The Dallas Fed Manufacturing Index is only negative 8.4. The estimate was, or the median estimate was for negative 15. So less bad. I feel like that's the motto for these things now. Is it less bad? The 6-month outlook coming in at negative 9.1. A little bit of improvement from the month before. All right, coming up, let's have an impact. We'll look at the impact of these job cuts we just talked about in tech, as well as with banks and retail. We're going to speak to someone who specializes in workplace culture. Jessica Kriegel of Culture Partners is up next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. In Iran, authorities say that a drone attack caused a heavy explosion at a defense ministry ammunition depot. The attack happened in the city of Isfahan. According to Wall Street Journal, Israel carried out the strike. The journal says the aim was to look for new ways to contain Tehran's nuclear and military ambitions. President Biden will meet with White House Speaker Kevin McCarthy Wednesday to discuss raising the debt ceiling and avoiding a U.S. default. Republicans want a deal that includes government spending cuts. The president has refused to negotiate over the debt limit. And job cuts are on the way at Royal Philips. The Dutch maker of medical equipment is cutting 6,000 positions, about 8% of its workforce. That comes on top of 4,000 job cuts announced last year. Philips is reducing expenses while dealing with the costly recalls of some of its consumer products. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. Let's continue the conversation on job layoffs, particularly when it comes to the jobs report on Friday. Joining us now, Jessica Kriegel, a chief scientist of workplace culture over Culture Partners, a business management consulting firm. Jessica, I take a look at the data, and there's a big discrepancy versus the actual hard data, even some of the sentiment indicators versus the amount of layoffs that you're seeing, whether it's tech, banks, or retail. What do you ascribe this difference to?
Groupthink. These CEOs are falling into the trap of groupthink. They're seeing their peers have massive layoffs, and they're thinking, I've got to do the same thing. And it's a terrible mistake. The research shows that organizations that do not engage in mass layoffs going into a recession thrive post-recession. And those who do have layoffs struggle afterwards. We are always going to be in a competition for top talent, and the good CEOs know that. So part of it is also changing the narrative. I mean, they want to take the power back, so they've got an opportunity to do layoffs right now, and they're doing it.
Yeah, you do sometimes have to take a pause, don't you? It was only, 6 months ago that we would talk to executives and they said that the toughest thing is finding the talent. We have to hire.
Right.
And that turnaround has been so significant. But they did overhire. That would be the pushback. They added headcount during the pandemic. You look at the likes of Amazon, expanding by hundreds of thousands of employees over that period. They do need to cut back, would be the push on this.
Well, that's certainly the argument that they're using in order to justify the layoffs that they're having. But here's what's happening now. You've got these layoffs happening, which is going to create an experience for the employees who are left. The anti-work movement is growing. That sentiment is getting louder and louder on social media. People are being frustrated. Young men and young women are leaving the workforce because they are irritated with the nature of work right now. And if CEOs zoom out for a second, they're going to see that the long-term effects of this kind of action is going to be heartburn for them in the future. Maybe it works right now, but it's not going to work in the long term.
Right, but people still need to pay bills. So Jessica, I'm wondering, when we hear all these layoffs, right, and I can appreciate how if you're laying off like 0.5% of your workforce or 6%, in actuality it's not that huge. Where do they go? How quickly are they finding jobs?
About 1 to 3 months. I mean, for every large, big tech company that's having layoffs, there are many small organizations who are eager to gobble those employees up. So I wouldn't say that there's a dearth right now. What we're seeing, however, is CEOs taking advantage of fear in the headlines. They're saying, you know what? Everyone else is doing it. I can do it. I'm not going to be special news. I'm not going to suffer brand reputation from having done it because it's just what's happening right now. In reality, employees are going to be okay. Keep the faith. If you're an employee out there that's just been laid off, there are lots of organizations who would love to see you who are still trying to find those top talent.
And as you look at that demand then with those small organizations, and they can benefit clearly from this in terms of that access to talent, are there particular areas within the tech ecosystem that are most amenable to bringing those hirees back on?
I think it depends on there's the tech sector, then there's industry, there's Main Street, there's knowledge workers, there's skilled workers, and they're not all experiencing the same dynamics in the workforce at the same time right now. So you see organizations, employees who worked at big tech, and now they're taking a massive shift in their employment situation because of the nature of the economy and what they are available to them right now. So it's not one narrative. I mean, there's many different narratives. There are many organizations who are still struggling to find talent right now. And the companies that are going to win are the companies who understand that they have to create a workforce culture that helps employees thrive and feel fulfilled at work.
So if this isn't a sign of the macro, is there a place where it is? So I'm taking a look at banks, tech, retail, the industrials like a 3M is starting to do the layoffs also. Is there a macro signal anywhere where you look in that?
I mean, if I had a crystal ball, I would probably be rich, right? So I don't necessarily have the answer to that, and I'll let the stock analysts and the economists predict what's going to happen in the next 3 months. But what I do know is the number one indicator of success for financial results is if you have clarity of results. As a CEO, if you can be super clear on what it is you're trying to achieve and communicate that to your organization, that's going to allow you to win. So what I would do if I were CEO right now is be crystal clear on what are we trying to achieve in 2023, how can we all get behind that and do it together.
And you don't have a crystal ball, but give us a sense as to whether or not you think there are going to be further job losses. Is the bloodletting done at this point, do you think? I mean, particularly within tech and finance, or is there more to come?
I think there's probably more to come. I would counsel CEOs who are planning layoffs that haven't gotten to it yet with this one tip, though. Stop doing these middle of the night removing access to employees to let them know that they're being laid off. The CEOs who are really elevated are having upfront conversations. They're being transparent. They're exposing themselves to the difficult conversation about why are we having layoffs. They're allowing employees to ask questions. They're giving fair severance packages. And that is really the best way to lead with heart. It's the best way to create a workforce that in a few months, they'll want to come back. They'll be those boomerang employees that we were talking about in 2022.
So Jessica, it's just so interesting because I feel like the conversation for like a year was that power left with the employees, and then now it's shifted back to the employers. And you're saying that CEOs shouldn't necessarily get sucked into that, and they should still think of the power with the employees. How do they do that? Like, what's the best workplace culture to do that?
Workplace culture is not about perks. It's not about the ping pong tables. It's not about happy hours. And the CEOs who are trying to change workplace culture with those things are failing to leverage culture to get results. Culture is about results. And so how do you get results? It's through your employees' actions. Now, how do your employees take the action you want them to take? It's if they believe in what you're trying to achieve. If you can create the beliefs necessary that make them self-motivate to do the actions you want, then you've got something. And we do that through experiences. So CEOs need to be laser focused on what experiences am I creating? Experience in a town hall, experience when I'm having a conversation on a Zoom, or experiences in how we do layoffs, if we do layoffs. Those experiences lead to the beliefs you want employees to have, which will get the actions you want out of them, which is going to get you those results.
Jessica Kriegel, Chief Scientist of Workplace Culture at Culture Partners. Thank you very much indeed on the need for some of these executives maybe to take a pause on the job cuts and give it a long, hard think in terms of how they position for the next 24 months, 12 to 24 months ahead. Plenty more coming up. We're going to check in on these markets, some of the big movers across the European equity space. Stay with us. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Boeing predicts China will jumpstart global air travel this year. The jet maker says the reopening of China's borders will boost travel almost to pre-COVID levels. A Boeing executive reiterated the company's forecast that airlines will need another 41,000 planes over the next 20 years, with China a key buyer. Bitcoin is set for its best January since 2013. The largest cryptocurrency is up 40% since the start of the year. Meanwhile, smaller coins such as Solana and Decentraland have doubled in value. Investors are betting that monetary tightening and the crypto sector crisis are receding. Bloomberg's learned that LVMH and L'Oreal are amongst those weighing bids for a stake in high-end cosmetics brand Aesop. The company could be valued at $2 billion or more. It's owned by Brazilian cosmetics maker Natura. And that is your latest business flash. Tom?
Okay, let's get a check on markets and where we head, of course, into the final hour of trading in Europe. Across the benchmark, you're seeing losses here in Europe as we count down 35 minutes towards the close. But some disappointing data coming out from the likes of Germany, but also that inflation print out of Spain, a full 1 percentage point higher than the estimates, the average on the Bloomberg survey, 5.8% for the month of January. So you saw euro-dollar gain, euro gaining on the back of that. The single currency currently trading 108. On the back of that inflation print, expectations that the ECB will possibly have to go further. The terminal rate now from the European Central Bank, 3.5%, above 3.5% according to the money markets. That is the pricing. The ECB rate currently is 2%. Prosus, one of the individual stocks we're pulling out for you today. You just saw this big rout in Chinese tech stocks listed in Hong Kong, notably Tencent. There's a tie-in, of course. Prosus has about a 27% tie, or at least stake, in Tencent. So that's been reflected in what we're seeing here, currently down 7%, tying into the negative sentiment, at least for now, around Chinese technology, whipsawing, of course, around the sentiment, regulatory changes there. Ryanair, this is interesting, given their chief competitor, or at least one of their chief competitors, EasyJet, actually beat on the earnings front. Ryanair, it was a miss. Executives holding to their forecast in terms of the earnings story for 2023, but is disappointment from investors, currently down 3%. We'll see if that turns around in the days and weeks ahead. Of course, crucial in terms of the litmus test for that demand, particularly in Europe, for those cheaper flights. Ryanair currently down 3%. 34 minutes as we lead up to the close. Coming up on the European close then, Steve Jacobson, Saxo Bank's CIO, is with us. We're going to walk through some of his predictions, what his take is in terms of the terminal rate coming up for these central banks. A big week, of course, with the Fed, the ECB and the BOE, and his assessment in terms of the scorecard so far on the earnings front. We'll also get his views on how to position around the reopening of China. Stay with us. This is Bloomberg. It is Monday the 30th of January. Stocks trading in the reds. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Okay, let's check in on these markets. The European benchmark is lower. The one major index across the European space that remains in positive territory is the FTSE 100 here in the UK. But otherwise, there's a pause. There's an assessment ahead, of course, of those key central bank decisions. And also a bit of a mixed picture when it comes to the earnings front as well. The data has not helped. Certainly the sentiment here in Europe with GDP contraction in Germany coming in as a surprise. Just as people have started to assess whether or not, in fact, Germany could avoid a recession. The data comes through and poses a big question mark over that. Over in Spain, inflation coming in higher than expected as well, and that's leading into some bets that maybe the ECB is going to have to go further in terms of the terminal rate. That is shoring up the euro, the single currency, 108. Some of the strength of the early start of the session just ebbing a little bit for the euro dollar, but still 108, a little bit of upside for the single currency. A couple of individual corporate stories to bring to your attention. Yes, you had the Lunar New Year coming to an end in terms of the markets, at least in the mainland, back on the mainland trading, but over in Hong Kong, they've been open for a number of days now. A big rout in Chinese technology shares, and there's a link there. Prosus, listed in the Netherlands, has a 27% stake in Tencent, so that's falling and feeling the pain, currently down a little over 7%. Ryanair, this was a miss in terms of its estimates, putting it in a slightly different category, at least for now, versus one of its chief competitors, EasyJet, which came in with a beat. But it was a miss from Ryanair. They are still holding to their guidance, and executives saying they are still pretty positive about the year ahead. Nonetheless, the stock is down 3%. Alex?
Yeah, the commentary was pretty good, so that decline is somewhat surprising. All right, here in the U.S., you're looking at S&P rolling over a bit, although trying to make a run off the lows of its session, down by about 0.7%. The Nasdaq 100, though, now below its 200-day moving average. We had seen a nice extension through that level last week, and now it looks like we're unable to hold it. Individually, I did want to focus on Ford. They're cutting their prices for their EV Mustang. We can say it's because it's going to compete with Tesla, but it's also part of the Inflation Reduction Act. They had to lower the price to get the tax subsidies, and I have to wonder, will the Inflation Reduction Act actually lower inflation? I find that to actually be a quite interesting conversation. Now, the bond market, and you're seeing yields move higher by 6 basis points. This is really what did you do to us, Europe? Because this is a Spanish inflation conversation, a weaker German growth, and it feels like the bond market is selling off in sympathy with Europe as we head into the Fed meeting that kicks off tomorrow. Tom?
Yeah, a 10 basis point move at the front end, the German 2-year. It's quite notable, 268 on the German 10-year. Again, that is linking partly, as you say, to the GDP data, but also that surprise when it comes to Spanish CPI. We have a terminal chart that just shows how, to some extent, across the Eurozone, Spanish inflation is a bit of a leading indicator, arguably. So is the turnaround, at least for the month of January, does that suggest that maybe other nations across the Eurozone will start to see that pick up as well? And how concerning should that be then, as you start to price in further rates from the ECB? And it's been really interesting to hear from the likes of Christine Lagarde just pushing back on some of that dovish commentary from some officials within the ECB saying, look, we are going to have to go further, at least 250 basis point hikes. So we'll see how that transpires, but certainly in terms of the sell-off across sovereign debt markets, that's been quite pronounced, and again, within euro dollar. So Spanish inflation, a bit of a surprise, Alex.
Yeah, and that sort of brings into what Australia was saying last week, too. Like, and prices can come down, and they can also go back up. Like, they don't need to be a straight line either direction, so there still is going to be that inflation risk. So to that point, global macro economist over at FIL Investment Management earlier on Bloomberg talked about that steeper inflation print.
The Spanish print this morning is for sure a signal to central banks that they should not be taking for granted even a couple of successive declines readings of inflation, because inflation is sticky. It just says to central banks that they should not be pivoting before they're confident that the inflation has been tamed.
Okay, our question of the day then, what is the terminal impact across these asset classes? Joining us now here in London is Bloomberg's Noor Al-Ali, and with us in Frankfurt is Bloomberg's Jana Randau. Noor, let's start with you on the Spanish CPI print and the surprise there, at least in terms of the surveys of economists. What does it tell us The market's pricing in, money market's now pricing in 3.5%, above 3.5% from the ECB. And we've heard this very public spat between officials at the European Central Bank. And now maybe we understand why the hawks remain as hawkish as they do.
Absolutely. And you know now why 50 basis points absolutely priced in for this week and potentially even for next week. I know there was a debate now increasingly about what we're going to do in March, but this inflation print out of Spain is really tone setting for the euro area. We know that we have German CPI data tomorrow. Perhaps it'll give us a softer print. We had, the economy contract unexpectedly out of Germany today, but we know that Spain, as you just showed, is the leading indicator for a lot of the traders and analysts that I talk to. So definitely you do see money markets now potentially getting on the move here. And, perhaps we should start saying don't fight the ECB as well.
No, yeah, exactly. So, Yana, if the markets are finally going to wise up to the don't fight the ECB, they're definitely fighting the Fed. If they're not going to fight the ECB, what does Lagarde then have to say this week to really throw it down?
Well, certainly that half-point hike that everybody has been expecting is even more so than it was before a done deal. So we will see a 50 basis point hike this week for sure. The interesting one will be March, and we've really seen a mixed bag of data. German economy is contracting, so a lot worse than expected. On the other hand, economic confidence is picking up. Spanish inflation indeed doesn't look good, but there is some uncertainty around that inflation print. It's not good. It's not going to get any better, but we're seeing some statistical quirks here at the start of the year, a change in the base here, a rebalancing of the consumer basket. So that print alone is not going to get anybody panicked, if you may. So we are going to hear very strong language out of the ECB, potentially some hints on what the March projection update will bring, and certainly some strong commitments from the president.
So strong commitment, strong language from the ECB. If a terminal rate of 3.5% does come through, Noor, what does that do to this equity market? You've seen European stocks rally, close to 6%. Does that derail the European pivot that we've seen?
I think potentially yes, and the reason I'm stuttering is because a lot of the analysts that we spoke to, we had the MLive survey last week, and everyone was pretty much expecting that, the bottom isn't in yet. And so, there's a lot of optimism. We're trying to change that narrative from last year. January, you've had the Lunar New Year, you've had China reopening. Everyone was just riding on that wave. Potentially European stocks could fare better than U.S. stocks because, there could be a shelter if you're looking at that China play. You're looking at European stocks from that reopening. Japanese stocks, definitely you are seeing that we're still away from the peak that we saw in the last year. But there's definitely a lot of room here where you think higher interest rates, economies still struggling, inflation still quite elevated, potentially a good play for the euro, though stocks not so sure yet.
Yana, there was a great piece out in the FT that talked about the plans that Europe is going to have to combat U.S.'s IRA, Inflation Reduction Act, talking more subsidies, do we do joint borrowing, whatever comes down. It's serious. Like, the need to get money out there and spent quickly is real. Does the ECB hate these conversations?
Well, I think everybody is aware that a lot of spending needs to happen. Also in Europe, when you talk about the transition, I mean that's ultimately what what people are concerned about: getting inflation down, raising interest rates. At the same time, you have to spend on greening the economy. So the ECB always says they are very much concerned about the eurozone. They are quite confident that they can get the job done. And what happens in the US, they monitor, of course, but their focus is very much, on what's happening at home.
I mean, it really is a fascinating dynamic in terms of the European response to that Inflation Reduction Act. Yana, I wonder if we need to start thinking about sovereign debt again. BTPs, yields up almost double digits, at least at the front end. I'm thinking the 2-year currently 3.15, that's a move higher by about 11 basis points. Is there a concern? Are you hearing any ranklings, any angst around the sovereign, around the peripherals, or has that been put to bed?
No, I think the ECB is very clear, and it has very, a very solid layer of safety nets to deal with any problems. So far, we haven't even heard that there's, major concern about what's happening in the market when it comes to debt sustainability concerns. They have flexible reinvestments of their pandemic program. They have two standby facility, the relatively new TPI, which was created when the ECB started raising interest rates last year. There is still the OMT, which was created during the debt crisis in 2012. And between all those different layers and safety nets, the ECB is very, very confident that a debt crisis can be kept in check.
All right, thanks so much, both of you. Wonderful setup to what's going to look like a very difficult trading week. Jana Randall, Bloomberg, and Noor Ali, thank you so very much. Coming up, more on the market impact of this week's central bank decisions. Steen Jacobsen, Saxo Bank CIO, is joining us next. This is Bloomberg.
Earnings season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number.
Blowing through estimates.
These guys are minting money.
With exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
This quickly become just a really crappy business model.
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Right, let's continue our conversation on central banks. And our question of the day, of course, terminal impact, and to what extent these terminal rates that we are getting closer to, it seems, and how that will feed through to these asset markets. Joining us now is Steen Jacobsen, Saxo Bank CIO. Steen, thanks for joining us. We were speaking to eToro earlier. Now, they see 5% terminal rate, and that being held for about 6 months. What is the terminal rate that you're starting to price for, and what would a 6-month hold at that kind of level do to these equity markets?
I like the whole concept that the premise here is that we are at terminal rate, which is interesting, but of course is what the whole market has been doing. Basically, I called it two and done. So basically the market, of course, looking for 25 basis this month and 25 next month, and then whatever pause that we come up with 3 to 6 months. I think the reality is a little bit different. Right now we are sort of fighting between a soft landing and a recession, with the soft landing have a bit of an upper hand. But having said that, I think the third way is basically the right way, which is that the Federal Reserve will be stalled at this level while the data from first quarter in that last year comes in. Of course, Ukraine in February and the likes is already impacting the like-for-like year over year. But as we speak today, gasoline prices is up 10%. Every leading high-frequency data point is indicating that we will be accelerating inflation already in January. And add to that the four components that's been creating this rally, which is the MOVE index, so basically the volatility of bonds has collapsed, the dollar has collapsed, the forward Fed action over the next 18 months is priced at 80 basis points, and most importantly, obviously, financial conditions is today easier than when the Fed started hiking in March of last year. In other words, what you need to expect is that, yes, things are priced to perfection, including your premise of your question, but as we come into the second half, two things will change. Financial condition will put an upward pressure on the economy, no recession, and the biggest event this year so far, of course, has been the turnaround in China.
Right, so let's get to that. So what kind of reopening do you expect then in China? All holds barred? Is it going to be lumpy? And then is that growth or is that inflationary? And then how does that feed through then to the terminal impact conversation?
So the quick and dirty one is that 1 percentage point increase in growth in China is worth 25 basis points worth of growth in the US and 35 basis points in Europe. The way that this will happen is due to logistic, that the initial phase, of course, is the announcement. The second part is that people get sick from, of course, the abandonment of the COVID-0 protection. And then the economy moves into what we'll see over the next couple of months, a massive pent-up demand from the consumer side, having been locked down for 3 years, including, of course, and certainly adding to global growth, the travel overseas. I note that UK is about to upgrade its
looks like we're having some
GDP based on Chinese tourists alone.
You know what?
Are you with me?
It looks like we're having some connections issues, Steen, so maybe we can try and reestablish that. But Tom, I think that the point there is that no one really knows what to do with China. It's still, in essence, kind of a crapshoot. If it reopens, people get sick, then what winds up happening? Is it going to be the pent-up spending, and does that wind up being somewhat inflationary, or is it going to be a rolling set of lockdowns? You can kind of see it in the options market, too, that you're taking on a little bit more two-way risk at that point.
Yeah, and then look, there is a sweet spot that you could potentially get here, depending how you look at it, where you get the consumer coming out gangbusters, you get a push around services in China, but you get less stimulus in terms of infrastructure build-out because of the indebtedness, and we saw that, record deficit levels at the local government level, which means that maybe you avoid that inflation hike, but that is a big if, of course. I mean, anecdotally, speaking to people on the ground in China, they are desperate to travel and they're desperate to spend.
Yeah, 100%. Whether or not you can do it is a whole different story, and the credit impulse very different than usual. Okay, Steen, I think our connection is good. So we kind of lost you in the middle there in terms of, China comes back, but then maybe people get sick, and then what happens after that?
Then you have the carryover, which is that 1 percentage point increase will lead to 25 basis points of growth in US and 35 basis points in Europe, which means everything being equal, China will come back from 70% capacity in the economy, the lockdown, and then to 100%. That will mean at least half a percentage point on top of what we already see in terms of a US economy. And as you just talked about, the European economy that continues to outperform, certainly on unemployment, but also on economic activity. In other words, your whole premise, in my humble opinion, is wrong. I think terminal rates is a conversation with the three of us needs to have at the back end of this year, not in the middle of the summer.
Okay, so maybe it's a little premature, Steen, blowing a hole in our question of the day. How do you play the China story then? Steen, do you want to be going and buying A shares, or do you play it through, for example, European luxury?
Certainly through European luxury. I'm not really I used to have an exposure to China. I've taken it off in this rally that we've seen. And overall, I'm a bit skeptical on the sort of the Chinese market. As someone who travels to China 3-4 times a year, I do realize that it's a momentum-based business. Of course, a large part of the move we've seen this year has been the fact that most managers has been underweight China. So similar to what we've seen in the Western markets, I think a lot of what we've seen in terms of liquidity here is surprising economic data, surprising liquidity provision, the general account in the US being a great example, Japan with the YCC. So overall liquidity has been richer than expected, and we've ended up that the short covering has been sort of 80% of the drive that we see north in equity valuations.
So, Steen, wrap that all in for me. Where's the biggest misprice then in the market? With the terminal rate conversations at back half of 2023, if there's still questions about China reopening and the move's been a lot of short covering when it comes to equities, where's the misprice?
So I think the equity market is getting to certainly a fair price, and if you look at the technical pattern, I think it's also around here. We need to decide this week, of course, being a massive, probably the biggest one ever in history in terms of the aggregation of data that comes out. The biggest misprice is Fed and the Fed action going forward. The mismatch you see between your question, the terminal rate dictated by the market, and the one dictated by Fed, is clearly out of whack. One of the two is very, very wrong. I happen to think, not that I'm normally a person who goes with the central banks, but I'm pretty sure that the Federal Reserve, given the economic conditions, given China, and given the liquidity in terms of the easing, will need to come out hawkish, not only in the press conference, but over the course of the next 6 months. So in other words, the Fed will deliver, and the market will not like it as we come into the second part of the year where the market is pricing a card from Fed.
Steen, has the bond market rally overdone itself then?
Partly no, because what did happen last year, of course, was that the liquidity premium, which is expressed in the MOVE index, came up massively. There was a disengagement from investors. There was an underweight in the space, and that volatility and that move that we see in the fixed income is wholly collaborated and should be executed at its fair value. But I think from where we are right now, one of the things I'm watching for this week, I know all of you are watching whatever goes on with the with technology groups and the companies and the non-farm. But for me, the most important number for this week is where 5-year ends on Friday night when we close the market in New York. Because to me, there is a small turnaround in the fixed income market right now. They are fairly priced, in my opinion. And as such, they need new direction. And I think that new direction will be a slightly more hawkish as we look into increased data in terms of, again, China, inflation picking up a little bit, and energy picking up a little bit overall.
Yeah, that goes with what Ira Georgi was saying about positioning in the market's pretty neutral going into that. All right, Steen, really appreciate it. Steen Jakobsen, Saxo Bank CIO, joining us there. We're about 9 minutes away from the close over in Europe. This is Bloomberg.